Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. With the recent market volatility, investors are looking for ways to help control their risk. So here to talk with me is Grant Copple. He's with Innovator ETFs to talk about using a buffered ETF strategy. So Grant, where do we get started?
Yeah, thanks for having me, Jim. So defined outcome investing has been around for decades. We're just used to seeing it inside of either structured notes or index annuities. What's different about buffered ETFs is it offers these payoffs where you can participate up to a cap, then with having a built-in buffer, not inside a note or annuity, but inside the ETF.
So can you give us an example?
Yeah, for instance, you can get a buffered ETF that offers a 15% buffer on the S&P 500, meaning that over the course of a year, if the S&P doesn't drop more than 15%, you're fully buffered, and then you participate one-to-one on the upside to a cap. So for the sake of the example, let's say that the cap is 12% and the buffer is 15. If the market goes up 10, you get it all. If it goes up 20, the most you can make is 12. Then the downside, if the market drops 13, 14, 15, you're fully buffered. If it drops 20%, you'd be buffered the first 15 and then lose 5.
Okay, so in your example, if the market drops 20% and I'm down 5, maybe even a little more with the fees from the ETF, if I choose to renew the ETF the following year, aren't I buying back in with the market down 20%, but my money's only down 5%?
Yeah, that's exactly right. So if the S&P was down 20%, you'd only be down 5% at the end of the year. And then actually what happens with buffered ETFs is they automatically roll the next year for you. So you're only down 5% the first year while the market's down 20. And then the next year you get a new 15% buffer and then a cap that's different. The cap could be higher or lower the next year.
So I see what you mean with similarities to an annuity and the buffered between you and risk. But why would you choose, say, an ETF as opposed to an annuity?
Yeah, I mean, to keep it short, you have all the benefits of the ETF, but really the major one is liquidity. You have all the flexibility of daily trading. These products, they trade on the exchange. There's no surrender charges or any lockups where you'd be forced to hold this product for over the year.
So how are these ETFs structured so that liquidity is possible and you can still have the idea of a defined outcome?
Yeah, so they're a little different than the traditional ETF. If you do want to fulfill the full defined outcome, meaning if you want that full 15% buffer, and in our example, a 12% cap, you do have to hold a buffered ETF for its full term, which in this example would be 12 months.
So there's still something like a term in play here, but it's much shorter than a product like, say, an annuity, and you still do have liquidity, which are both positive.
Exactly, especially with all the volatility that we're seeing this year.
It's also important to take a balanced approach to investing. Every strategy has its pros and cons. So in this case, while this can be a great way to buffer against market volatility and risk, it could also limit your returns. Thanks, Grant. And this is why it's also so important to discuss this with a certified financial planning professional, or CFP, that understands your goals and objectives. If you have questions about your risk or want to discuss options during our current market volatility, give us a call.